Hello everyone and Happy New Year! I recently posted on my Instagram and Twitter that I was going to be doing a Q&A on my channel and asked my following to ask me some questions. So this video is going to be going through the questions that I was asked, and there are some really good ones in here that I think will give a lot of value. So this is going to be a value-packed video, and I put timestamps in the description so you can jump to the questions that you are specifically interested in. With that being said, let's hop right into it. Alright, so the first question is, are penny stocks a good chess move to flip maybe a low-risk fund like $500? Personally, I would say no, and the reason is because this is more gambling than investing. Investing is buying a fundamentally sound business and allowing it to grow over the long term. Gambling is buying a stock because you think it will go up in the near future. No one knows for certain what prices will do in the short term, and you have no edge by doing this. The chances of you making money are about 50-50, but I would actually say that they are worse than 50-50 when you are buying a stock and trying to flip it quick. So for me, I only buy stocks of businesses I feel confident will continue to grow over the long term, and as they grow, so will my investment in them. Alright, moving on to the next question now. What companies do you recommend for getting the best dividends? Well, I cannot recommend anything on my channel as I am not a financial advisor. But what I can do is give you my opinion on how I think about dividends and use them in my own portfolios. Personally, I love dividend growth stocks, and Alimentation is a good example of one. Alimentation currently has a dividend of 0.89%, which does not sound like a high dividend, right? But take a look at its historical dividend growth. The dividend has grown from 1.7 cents per share back in 2004 to 70 cents per share today. This is growth of about 42 times over the past 20 years. The dividend has also grown by 28% annually over the past 5 years. Since Alimentation's dividend grows so much, it means that the dividend on the cost of shares today also grows dramatically over time. For example, if you purchased Alimentation shares back in 2000, then you would have a dividend yield on cost of 134% today. This means you would be getting your entire initial investment back every year in dividend income, and then some on top of that. So Alimentation may pay a small dividend today, but as it continues to grow in the future, it can become a significant dividend payer on shares purchased today, assuming that it will continue to grow its dividends in the future, of course. As a result, some of the best dividend income stocks can actually be stocks that grow their dividends over the long term. So for me, I really like to buy and own these types of stocks, because by the time I retire, my dividend income could grow into something truly incredible. Alright, moving on to the next question now. This one is one stock I would put my money in and leave for life. Basically, if I could only buy one stock, which one would it be? For me, this one would be Brookfield, and I cover Brookfield a lot here on my channel, so you have probably already heard me talk about this one a lot. But Brookfield is a business that resonates a lot with my own investing style, and I have a very high conviction in the business over the long term. It's also the largest position in my portfolio right now, by far, so this is the stock that I would go with. Next question. Biggest obstacles you have had to face in this whole venture? I think this question is in regards to my YouTube channel. So the largest obstacles I have faced have all been mental. They have been me having imposter syndrome, being depressed, and having anxiety. To me, I am just another person, and I do not feel like I am special, which makes me feel like I do not deserve the following that I have. This sometimes leads me to feeling like I have no right to make the videos that I make and having an audience this large. That leads me to having anxiety and sometimes becoming depressed. I have spoken about this on my channel before, and how years ago I would drink before making YouTube videos to give me a little bit more confidence, and how I was on antidepressants for a while there. However, I am happy to say that I no longer have to rely on medication or alcohol to combat my anxiety. I think that they were crutches that I was using while finding a long-term healthy solution. For me, those solutions have been exercising, eating healthier, being more mindful and in the moment, and learning to believe in myself more. It took time, and honestly, I do still have days where I get depressed, but I am doing so much better, and I am no longer relying on antidepressants at all. I am very happy I got off of them. So, in conclusion, my biggest obstacle has been my own mind, and I also think that this is the case for a lot of people. You have to believe in yourself, because believing in yourself is what counters the negative thoughts and voices in your head that tell you that you cannot do something. That voice is wrong, but you have to believe in yourself to know it's wrong. So in the end, I think the most important thing that's helped me overcome obstacles is believing that I could overcome them. Alright, moving on to the next question now. This one is what percent of one's portfolio should be in hypergrowth small cap stocks like serial acquirers. This is an interesting one because there's no set percent that you should have in anything. Everyone's portfolio should be unique and a reflection of them as an individual. For example, I have a good portion of my portfolio invested in smaller cap stocks, but I am comfortable with this because I believe they are still high quality businesses that I also understand very well. However, someone else may not feel comfortable owning small cap stocks, and therefore they probably should not own them. It all comes down to the individual and what they feel comfortable with. One mental test that I do is I ask myself, if the stock falls 50%, will I see it as an opportunity or will I become nervous? If I will see it as an opportunity, then it's a stock that I can own. But if I will become nervous and end up selling it while it's down, then it's a stock that I should not own. But again, there's no percentage of your portfolio that everyone should put towards small cap stocks or a specific industry or anything. For some people, it may make sense, but for other people, it's not the best idea. Moving on to the next question. What is the highest risk-reward stock that I own in my portfolio? This one is also interesting because in the stock market, I actually do not believe that risk is tied to returns at all. In a lot of cases, risk actually equals losses. For example, I think Beyond Meat is an incredibly risky stock because its fundamentals are awful. The business is losing a lot of money and it has over $1 billion in debt. So over the long term, I think this is a highly risky stock to own. And you can also see that its performance has been horrible because of how poor its fundamentals are. On the other hand, a business like Constellation Software, which has some of the best fundamentals and lowest risks I have ever seen, has produced returns of over 100 times over the past decade. This means a $10,000 investment would have turned into $1 million. Yet I do not believe this stock is risky, because again, its fundamentals are absolutely incredible. In conclusion, I do not believe that risk equals higher returns in the stock market. Instead, I try to invest in high-quality businesses that can produce significant long-term returns with little risk. And to be clear, I did not always invest this way, and I have lost a lot of money publicly on my YouTube channel. But taking these losses and learning from them has guided me to my current investment style and significantly improved my own returns. In conclusion, I wouldn't think about needing to own highly risky stocks to produce high returns. The data suggests that high-quality businesses are what produce high long-term returns. So I would focus on finding high-quality businesses instead. Moving on to the next question, which now comes from Twitter and is from Jake, the co-founder of Stock Unlock with me. He asks, what is the stock you've made the biggest public mistake on? And what's your biggest learning from the mistake? Contenders are Next Green Wave and Trulieve. Thank you, Jake, for calling me out there. I love it. Then he says he personally learns the most from me when I review my failures instead of my successes. Jake, this is one of the reasons why I love you and why you're a great co-founder. I agree with you that you learn a lot more from your mistakes than your successes. In fact, I believe that too many successes can breed cockiness, which leads to taking on more and more risk until you eventually blow up your portfolio. Mistakes are what keep you humble and keep you learning. Therefore, they are really important and should be celebrated and reviewed intensely. So with that being said, what was my largest public mistake? Well, that's easy. It was obviously Trulieve. I made a lot of mistakes on this one, and I actually made an entire video on my channel to review all of the mistakes I made on this investment. But here's the number one takeaway that I learned from Trulieve. You have got to invest in businesses with moats, and here's why. Initially, when I looked at Trulieve, I saw a business that was growing its revenues and earnings insanely well. From 2017 to 2022, it grew its revenue from $3 million to $1.2 billion. That is insane growth. Its earnings also grew from basically nothing to $93 million, while also maintaining strong revenue growth. So to me, I thought that this was a hyper-growth business that was able to continue growing profitably as the cannabis market in the US expanded. However, what I did not consider was that the business's growth and profit margins would collapse. Trulieve's revenue has now been declining for over a year consistently, and the business is now losing tens of millions of dollars per year. So why is this happening? Well, it's because cannabis is a commodity, and no business within the industry has any pricing power at all. Consumers don't care which brand of cannabis they buy. All they care about is which cannabis is the cheapest. Therefore, the businesses within the industry can only compete with each other on price, and as a result, prices for cannabis have absolutely collapsed. This means the businesses that sell cannabis, like Trulieve, have seen their revenues start to fall as well. And since they have to lower the prices of their products, it means their profit margins have collapsed too. So what once looked like a highly profitable and growing business has fallen into a declining and unprofitable one, all because it does not have a moat that protects its pricing power. This is also a symptom of new industries. You see, new industries such as cannabis can see a wave of strong demand initially. In the beginning, there's not a lot of competition and there is more demand than there is supply. This leads to the businesses in the new industry to see strong growth and profitability. However, as the industry matures and more competition comes in, the growth and profits can decline. As a result, new industries can initially look very exciting, but the reality is that you do not know the long-term economics of them. This makes investing in new industries quite speculative as well. I could talk about this loss all day, but I think that I have made my largest lesson clear. So let's move on to the next question. Capital Growth asks what I think about Aritizia, which is a popular fashion brand. This one is interesting because I have actually looked into Aritizia stock before, as the stock is also down 50% from its all-time highs. The business saw strong revenue growth from 2020 to 2023, but its growth has been slowing down, and it's not a very profitable business. In fact, its operating cash flows have hardly grown in the past 5 years now. I also do not understand the moats in the fashion industry. For example, I have no idea why a consumer is buying Aritizia over another fashion brand, and if they will continue to do so over the next decade. Like, is Aritizia a fad, or will consumers still be buying its clothing in 10 years from now? I have no idea. And whenever I do not have confidence in the long-term economics of a business, I cannot invest in it. So for that reason, I will not own Aritizia or any other fashion brand. Remember, a business has got to have a strong moat for me to invest in it. Otherwise, I am potentially repeating my past mistakes. Alright, the next question comes from Ashish, and they ask which among RY and EQB is overvalued right now. In my opinion, it's RY, but which Canadian banking stock will you keep as your #1 pick for the long term, if you have to keep only one? This is a great question. So right now, RY is selling for a price to earnings of 12.8, and EQB is selling for 9.4. On a PE basis, EQB is the cheaper stock right now. However, when you take a look at these two stocks' historical averages, they are both selling above their average price to earnings ratios, which could suggest that they're both more expensive than they have historically traded. In my opinion, I think RY is actually selling for about fair value though, and I think EQB is still undervalued. And here's why. Over the past decade, EQB has grown its net income at 13.4% annually versus Royal Bank's 6%. So EQB is growing more than twice as fast as Royal Bank. Additionally, EQB is projecting another 20% plus earnings growth in 2024. So it's trading for a 9 price to earnings ratio while also growing its earnings incredibly well. So in my opinion, even though it is trading for a PE above its historical averages, I do still think it is undervalued. It's not often that I see a business trading for a 9 price to earnings ratio while growing its earnings so quickly and consistently. And in my opinion, it should actually trade for a higher PE than Royal Bank because of this. I think the discount doesn't make much sense and is offering significant value for long-term investors. So to answer the second question, I personally would own EQB over Royal Bank if I had to choose only one bank stock. EQB simply has more growth potential and is trading for a cheaper price, which should result in more long-term returns. However, I do own both EQB and Royal Bank in my retirement accounts, as I think they're both very high-quality businesses. But that's going to wrap up the video, everyone, and thank you so much to everyone who asked me some questions. I really hope that you all found value in this video, and if you did enjoy it, then please remember to leave a like on it, because it does really help out the channel and helps me gain a wider audience. Also, if you're new here and not already subscribed to my channel, then please consider subscribing, because that would also be pretty awesome, and you can follow along with my portfolio, all of my stock picks, and learn more about investing, as I do share quite a bit of investing tips on my channel as well. But with that being said, thank you all again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.